House prices are going to fall by 30 to 40% in Sydney and across Australia over the next 6, 12, 18 months. These are the type of headlines we're about to see not only on Channel 9 News, as well as every other TV station, but as well as articles that we see online. It's beginning to feel a lot like 2020 again. Now in this video, what I want to do is go through some charts, some statistics, as well as what my own thoughts are around what I'm seeing in the market from a price appreciation point, from a rental standpoint, and what this could mean in terms of real estate as an investment in 2022 and beyond. If you are interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Occasionally I'll have a go at these editors and how they come up with some real wacky headlines that cause some people to really panic. In this video, I'm gonna break this down with a bit of data, with a bit of statistics, as well as what I'm seeing across our buyers agency and the feedback that I get from you guys. Let's just find out what's actually about to happen. Now, if you are after more information around the economy, around what my thoughts are on a daily basis, Patreon. VIP Patreon group is in the link in the description below. If you want more in-depth conversations around access, as well as my insights around NFTs, crypto, and real estate, then definitely go join the mastermind as well. Now, we're aware that interest rates are going up from the bank's perspective. The RBA currently hasn't moved from their 0.1% cash rate, but there are expectations that this is going to change. We've seen the Fed come out in the US and they've increased their rates, and they've also gone on to say that this isn't the last of it. We're actually going to keep moving higher, and we're going to move at a rapid pace of like 50 basis points every single time. Now that's quite aggressive. That's because their inflation problems are super real, and some would actually argue that they didn't react fast enough to actually address the problem of inflation. Now, are we going to have a similar thing play out here in Australia? Well, let's find out. There are a few stark differences between what's happening in the US, around the world, as well as Australia. Now, if we look at from an employment point of view, things are looking pretty good, but we're always on this fear that everything's going to crash, the market's going to collapse, because there's things still happening around the world, and it's going to negatively affect us here in Australia. So far, things have been great. We've seen companies come out and want to hire more people. We've got labor shortages in some industries, and we've got unemployment at one of its lowest levels. We do, however, have the federal election coming up later this year. Now, around the election time, people get a bit scared, uncertain, because we don't know what policies are going to be coming into play, given we don't know who the Prime Minister is going to be. So we've seen this play out before, and when things calm down after the election, that's when we start seeing some more certainty in the market. So could we move sideways for at least the next 2 to 3 months? Yeah, I think so. Now, speaking of some outlandish articles that get the eyes popping, here's one that says house prices fall in 40% of Sydney suburbs. So dwelling values have dropped in nearly 2 in 5 Sydney suburbs during the last 3 months of the year, while almost half of Melbourne suburbs analysed posted price declines as the market downturn gathers pace, data from Corelogic shows. In a second here, I'm going to show you what the latest data from Corelogic is suggesting around not just Sydney and Melbourne, but across all of Australia. Of the 917 Sydney suburbs analysed, 354 logged a fall in medium dwelling values. House prices in 189 Sydney suburbs have slumped, while 165 unit markets weakened during the same period. We had already started seeing that the beginning of 2022, people are starting to pull back, and they're starting to pull back in the most expensive markets in Australia, Sydney and Melbourne. Now, if you go back and watch some of these old videos that I've got on the channel about 12, 18, 24 months ago, I was saying that if we see a market correction, it will be seen first in the emotional markets, the most expensive markets. And the reason for that is because this crash or correction is really going to come about because of lending restrictions tightening. So what that effectively means is that if interest rates increase, it means your level of borrowing decreases. You may not be able to get a loan due to your borrowing capacity at 3.5%, whereas you were able to get it at 2.5%. Now that the interest rates keep moving up at a rapid pace from the banks, that means people are getting priced out of the market. Now, either one of two things happens. If supply is higher than demand, prices go down. If demand is higher than supply, prices go up. In this case, what we're doing is we're taking a bunch of demand out of the market because they can't afford to actually buy a property at $1 million or $1.5 million in Sydney anymore, so they're gonna walk out of the market. Suddenly, people have choice. On the other side of the spectrum, you have a lot of emotional sellers. So they're sitting there and they're watching Channel 9 News and they realize
prices are gonna fall by 40%, prices are gonna fall by 30%. I better sell.
And the thing is, that causes an increase in supply, and we're already starting to see that across Sydney and Melbourne. Here are the latest index results from Corelogic. And what this is showing is that Sydney and Melbourne have started to record declines in their median house values. Now, given the quarter is still positive, I would say by Q2 of this year, we are going to see this number go into negative as well. And we can see the median value at Sydney is like 1.1 million and Melbourne is not far behind at 805,000. Now, Brisbane's been doing a really good job at catching up and they're at now almost 750,000, whereas Adelaide and Perth 602 and 542,000. Hobart is just kicking goals all over the place at 731,000. But what's more important is combined capitals and combined regionals. Combined capitals in the last month have recorded an increase of 0.3% versus combined regional properties at 1.7%. It gets even bigger when you look at quarterly, 1.5% growth in the capitals and then 5.1% in regional capital growth. So when you're really zooming out, you're starting to see that we have a two-paced economy when it comes to real estate. And this is how I've been sort of positioning not only my clients for the buyer's agency, but even for myself. I always knew that when we come out and we have some lending restrictions increase, we had to have that happen due to the fact that we've got inflation out of control. But when that happened, we could see a lot of demand will push into the more medium and lower end of the markets where you do have a bit more cash flow. When times start getting uncertain, you're not really going, well, I can put it in the bank, but I'm not earning anything. And if inflation is so high, I'm actually losing value. So instead, people are going, my flight to safety is investing that. And they may go, well, I could invest into stocks, I could invest into crypto, but they seem to be pretty volatile lately. Instead, if I go into real estate, do I really want to be in a negative cash flow environment of $200, $300, $400 a week just to hold this property when the market is supposed to decline? Instead, I can at least earn some yield while I've got into these cash flow properties, but as well as that, these properties are still growing. If we see people priced out of the $1 million properties and the 700, 800K properties, they're gonna go, well, what's the next best thing? And they're gonna come flooding in to the market between 300 and 500K. This is how I've been positioning it with our clients and the buyer's agency. We have really been focusing on the 350 to 550 range because that's where we're going to see the biggest amount of growth in the next part of this cycle. Now, when it comes to expectations around interest rates rising, here's one where CBA is actually predicting the lowest. So CBA believes that the increase in the cash rate will be about 1.5% to 2%, whereas other banks are predicting about 2% and the market is predicting about 3%. We always know the market is more emotional. They're always going to overshoot when it goes to going up, and they're also going to overshoot when it's going down. When it comes to other banks, and CBA included, I really don't push much weighing on these things because these bank economists have been wrong plenty of times. Yet, somehow we always fall for the trap of actually going,
yes, let's listen to them now because apparently they're going to get it right.
And that's okay. As long as you and I know that these guys can be wrong, it means we're not going to base our complete decision solely on the fact that some economists from banks said that prices will go down. This is where it comes down to your own strategy and understanding how much of an emergency buffer you have, how much have you budgeted, and what your time horizon looks like. If we look at historically what cash rates have done in terms of RBA's movements, there's only really been a few times in the last 30 years where cash rates have actually gone up. And we can see that here in about 1995, where we saw it go from 4.75 all the way up to 7.5, and that happened fairly quickly. And then from there, it plateaued and stayed there for almost a year, and we came crashing back down. Then we also saw it in early 2000, and that increase was from 4.75 up to about 6.5%, and then we came crashing back down to 4.25. Slowly by slowly, we made our way back up, and then of course we had the GFC, and we moved from 7.25% all the way down to about 3%. We tried to go back up, and the key word is tried, go from 3% all the way up to 4.75, and now we find ourselves in a position where we're at 0.1%. Even if we do see an increase that goes up by 2%, we will still be well below our average for the last 30 years. If you really overlay this with how Australian property prices have performed over the last 30 years, we've seen one thing play out, the same narrative, which is our currency is getting devalued, inflation is at all-time highs, which means it's gonna keep eating at our dollar. Does this mean we go out there, buy as many properties as possible and hope that we get another 10, 15, 20% growth in the next year? I don't think so. I think we're gonna start seeing a return to normal. It could be a new norm. It definitely won't be 20+% growth every single year. And I think the people that really win in this market are the ones that have a really good strategy, have an idea of their vision long term, and are able to actually execute with strong cash flow positions. Well, this is basically how I'm doing it. We're helping clients build the same portfolio and really go out there, leverage cheap debt, and despite it going up even by 1 or 2%, I think it's still a lot cheaper than the average we've seen over the last 30 years. I'm protecting my wealth against inflation, but I'm also hedging my bets, de-risking, and going across into other asset classes too. I'm not a financial advisor, and you should definitely not take any of this as financial advice. If you did need help around finding good real estate in Australia, then definitely do contact me down below. If you guys have enjoyed this video, smash that subscribe button, drop a like, and I'll catch you guys in the next one. Thanks guys.